To another market that's a little bit more mysterious even than interest rates, and that's gold. We're approaching $1,000 an ounce. As you can see, they're $9.95, perfect timing, just a couple of bucks away. There's all sorts of theories as to what's driving us here. We're certainly cracked out of the range and definitely going to test new highs, no doubt about it. Whatever your views on the precious metal, you can't argue with its direction right now. Nicholas Brooks is the head of research and investment strategy at ETF Securities, joins us this evening. What is going on with gold?
Good question. I think what's going on, I think there are two key trends taking place. Number one, I think you're seeing some of the slow-moving money, the very big slow-moving money, have been building positions in gold. We've certainly seen that in our ETCs. So we've seen about $1 billion flow into our gold in just the past couple of months. So that's been kind of an ongoing trend even when the price wasn't moving. So I think there has been this slow-moving money, and I think that's been focused on what's going on the fiscal side and on the debt side, because we have been seeing some pretty shocking numbers coming out of the UK, out of the US, and some other economies. I think everyone's known they'd be bad, but I think over the past couple of months we've seen some pretty bad numbers. More recently, I think what's going on is the risk trade. And I think a lot of investors are taking the view that the risk trade's gone a little too far, and that a correction is nigh. And in that type of situation, often gold will outperform. So I think in this type of situation, I think investors are moving into gold because they're fearful that we're going to see a risk correction.
Yeah. Can I just try and punch a hole in that last argument, which is that when people are forced sellers, one of the things they sell is gold. It's almost one of the first things they sell is gold. It's a liquid market. They can get out of these positions relatively easily. The idea that you buy gold to hedge yourself against some sort of downturn or market volatility strikes me, therefore, as a little bit insane. It's heavily correlated.
Well, the one argument I'd make against that would be last year. I mean, last year was a prime example. In the second half of last year, we saw pretty much every asset on the planet fall, but gold actually held up pretty well. So in US dollar terms, gold was up about 6% last year, while pretty much everything else was down 40 to 70%. And certainly if you looked at it in foreign currency terms, sterling terms, or euro terms, you did pretty well as well.
That's Pyrrhic, though, isn't it? Because you've lost your purchasing power in the domestic currency. And treasuries outperformed gold last year, and gold didn't test the highs even after the collapse of Lehman Brothers. We were 6 weeks away from complete collapse, and gold was falling. That's exactly, I think, where Guy and I are like mind about this asset and why I never understand it.
Yeah. Well, I think, again, it's all a relative game to some degree. So, again, you did get a positive return on gold last year, and it did hold up pretty well against pretty much everything else. Now, I suspect it would have gone a lot higher if people weren't doing exactly what you were saying, which was selling their gold in order to cover their losses. So you might have seen the gold price a lot higher if they hadn't been using it. And that's one of the beauties of gold to some degree, you could argue, in that it is liquid and you can sell it when you're in trouble.
One of the things that was pointed out to us a little bit earlier on was that at the moment there's a lot of indecision elsewhere. Traders can't make a good argument for getting into equities. They can't make a good argument for getting into the bond market. The relationship between the two is fairly opaque at the moment. There's a lot of apathy towards these other asset classes. You got a trend in gold, latch yourself onto it. This is hot money, and it's just got nothing else to do right now. Is that what we're seeing at the moment?
Usually not. I mean, I haven't seen gold really become as momentum driven as you might see copper or you might see some equities. So I'm sure there's an element of that in there. But I would say that, again, looking at what's been going on in terms of the gold ETFs and the gold ETCs, those flows have been very large. They stabilized and weren't doing much for a few months. And then over the past 4 weeks or 6 weeks, before the price moved, we started to see very large inflows, which indicates to me that that's more medium to longer term strategic money going in with a view the gold price will go a lot higher on a medium term basis.
Got to wrap it up there. Nicholas Brooks, thanks very much indeed for coming in and seeing us.